Hello, and welcome to the next in our series of webcasts on demystifying IFRS 9's impairment requirements. I'm Sandra Thompson. I lead our global accounting technical function for financial instruments. I'm here today with Mark Randall. Mark's a UK banking technical expert. We're going to talk today about credit cards and other similar revolving credit facilities. This is an area where IFRS 9 has some very specific provisions, and there is still some degree of debate going on as to exactly how to apply those provisions in practice, so it's proven to be quite a tricky area. Also, the requirements of IFRS 9 are different from those in the recent US CECL model. So Mark, can you give us a bit of background as to why there are some very special rules for credit cards?
Sure. So the general principle in IFRS 9 is that you look out over the period to which you're contractually committed to give credit when you're measuring your ECL. So in most instances that will be the contractual maturity. However, when the standard was being developed, one of the pieces of feedback was that for credit cards, many of those and other revolving credit facilities might have a one-day contractual termination date. And the feedback was that using that really was not going to give a representative expected credit loss provision when you compare it to the actual losses that credit card providers and other parties that advance revolving credit experience in practice, which really was the overriding objective of the standard. So for that reason, there's a special rule that was put into IFRS 9 for revolving credit facilities to allow a longer period to be considered. So really that's one of the really key areas for debate in the standard looking forward. And there's also a second issue really about how far back do you look when you're performing that assessment of whether or not there's been a significant increase in credit risk, which can be the catalyst to push you into stage 2, where your provision leaps up from 12 months to lifetime expected credit losses. So Sandra, maybe do you want to pick up the first one there in that backward-looking piece?
Yeah, sure. Thanks, Mark. So the first question is essentially, when do you start the clock for assessing significant increase in credit risk? Now, IFRS 9 requires you to look at a significant increase in credit risk since initial recognition. So this boils down to, well, what is the initial recognition date for something like a credit card? If you take the example of a customer that perhaps has had their card for 20 or 30 years, and maybe in that period a lot of things have happened. They may start off with a student card, sometime later morphed into a kind of normal card, and now be, say, on a premium product. And in addition, it's likely that their credit limit has been increased many times. There's now many multiples of what it started at 20 years ago. So the question is, well, is it really sensible to look back 20 years and deem that to be the date of initial recognition? There is no clear guidance in the standard. One idea that's being put forward is that you might look at some intervening date, in particular the date when a bank last did a full-scale credit review, and in response to that increased the credit facility of the customer significantly. The idea behind that is that is equivalent to the bank essentially starting again as it would for a new customer. As I said, this is a judgmental area. There isn't at present a consensus, so it's one to keep an eye on. Mark, do you want to tell us about the second issue?
Sure. So as I said up front, there's a special rule within IFRS 9 for the period out over which you look into the future when measuring the expected credit losses on a revolving credit facility like a credit card. And the key principle within that is you look at the period over which the entity is exposed to credit risk, which would not be mitigated by credit risk management actions. And it goes on to expand on that and gives 3 different examples of factors you might consider when trying to work out, well, what is that period? So the first is the period of exposure for similar instruments, which many kind of view as being essentially the behavioural life of other similar instruments. The second is the period over which it takes for instruments to default. And then the third is the period of time until you take credit risk management action. So either a reduction in limits or a termination of any unused limits. The key question, though, is do you place emphasis on one of those 3? Do you look at all of those 3 together? And really, how do you put that into practice?
Thanks, Mark. I've heard that some banks are wanting to place more emphasis on the third of those, the period to take credit risk management actions, and perhaps use that for all of their book. Can you give us the latest insight on whether that is appropriate? Sure.
Yeah, that's very much a view that I've heard, and kind of a way of applying that can be that if a bank does an annual credit review of its entire credit card portfolio each year, then one view is, well, if theoretically 100% of the cards could be terminated in 1 year, then isn't that supportive of the view that the period you need to look out over is just that 1 year? The ITG discussed a question on this area when they met, and one of the key principles they focused on was that it doesn't matter what might happen theoretically, what really matters is what you expect to happen in practice. So taking that example of the annual credit review, if in practice all that happens is that, let's say, 5% of cards get their limits terminated or reduced at that 1 year point, well, for the remaining 95% of the portfolio, the clock is still ticking and the life is some period longer than that 1 year. So kind of taking that view, just saying that the life is 1 year for the entire portfolio really wouldn't look to be sustainable.
Thanks, Mark. I think you said this is still another judgmental area where there's yet no consensus. What would you advise banks to do in the meantime?
Sure. As you say, it's still in flux. It's a difficult area, but I think there were two key thoughts I'd have. Firstly, try to retain as much flexibility and optionality as you can within the way you're implementing your IFRS 9 model in this area, so that ideally it can adapt if and when consensus does emerge. The second would be really maybe think about it in two ways. Firstly, almost ignoring what IFRS 9 says, well, what is the behavioural life of these credit cards? And then overlaying on top of that some additional modelling to take account of the impact of the IFRS 9 guidance, in particular the piece around credit risk management action, and working out kind of to what extent is the life of the credit card foreshortened from what you might view as a so-called pure behavioural life to the life that IFRS 9 is really after. But as you say, that the jury's still out on this, there's still lots of debate to be had, I'm sure.
Thanks, Mark. I think there's some very useful practical tips there for banks. So just to recap, IFRS 9 does have some special requirements for credit cards and other revolving credit facilities. However, there's still some uncertainty about exactly how to apply those requirements, and in particular, what's the start date for assessing significant increase in credit risk, and then how far forwards you look when measuring the ECL. Given the uncertainty, a key practical tip is to build as much flexibility as you can into your modelling. That's it for today. I hope you'll join us next time. And if you'd like to subscribe for the whole series, please click on the button below. Bye-bye.